That's right. If you follow the YouTube Jimmies, you will more than likely get wrecked. And that's a bit about what I'm going to talk about today. For those of you who don't know, YouTube Jimmy is our pet name for all the fake technical analysis gurus. They do silly technical analysis or traditional technical analysis, what I call voodoo technical analysis. And generally speaking, they don't have a clue what they're talking about. How do I know that? We'll get into that. But if you're familiar with my videos, you know what's coming pretty much. But I do have some surprises for you. And, well, anyway, let's get into it. So, traditional technical analysis, was favored by certain people in the trading industry for many years, professionals even, until it wasn't. And the reason that it became out of fashion and out of style, and basically not used by the overwhelming majority of actual trading professionals, is because those traders have figured out a better way to trade. And that better way to trade started with the whole Black-Scholes formula. How you doing, buddy? Hey. That better way to trade started with the Black-Scholes formula for trading options. The whole idea was to use volatility in order to actually have a degree of higher certainty and lower uncertainty, right? Higher confidence. Probabilities would favor your trade, right? That you would take the trade that has the higher probability, and that you would do that using a formula that was capable of measuring volatility. Once they were able to figure that out, they were able to make certain decisions and have a better performance overall, and that caught on very quickly with options traders on the markets, and thus was born the modern options trading market. Obviously options have been traded for hundreds if not thousands of years actually, but the modern digitized options trading market, the quant-based, right, quantitative analysis-based market, really began with the Black-Scholes formula in the 1970s and 1980s. Right, late 70s, early 80s, it became all the rage in the 80s and quickly developed. And the founders of that company, of that formula, two of whom, went on to win the Nobel Prize, Black and Scholes, they won the Nobel Prize for their efforts, along with their third collaborator who really, came on and helped them to express it better to the layperson. Anyway, so I don't want to get too bogged down by that, but the point is that was the birth of the current volatility trading industry, which has evolved a lot since then, and with our tools has evolved even far more, especially for retail traders who frankly did not have any of the tools generally available until quite recently. Our versions of them are far better, frankly, than even the versions of kind of primitive versions that existed by one or two other people developed over the years, available on places like TradingView, etc. But in general, these tools are not available anywhere to most retail traders other than that. And they're hard to find because all the algorithms will mute the content. They don't want you to know about it. If you're new to this channel, welcome. You're one of the lucky few people who's found it. And there's a reason for that, obviously, is that who uses the volatility to trade, who uses entropy to trade, who uses actually relevant probabilities and statistics to trade? The smart money. right? Who are the smart money? They're the people who run the markets, right? They're usually on the right side of the trade. They're racking in massive potential, massive profits on a regular basis. And they consider everybody else who uses traditional technical analysis to be what they call the dumb money, okay? Don't be offended by it. That's just what they call anyone who doesn't use smart money methods of trading. And among those smart money methods of trading, and really the leading method for high frequency trades, I'm not even talking about long-term investments with inside deals and all that stuff. I'm just straight up normal trading on daily markets, right? Intraday, right? Very low time frame, high frequency trades. That means that they do many trades, in a short period of time, high frequency, right? So their servers are capable of running millions of trades per second, and they do. And their average trade lasts less than 0.2 seconds or thereabouts. Why? Because they have such large positions that it barely takes any time for them to move a market in a particular direction, even for a blip. As soon as they move that blip, they take their liquidity right off the table. So they're not in positions 5, 10, 15 minutes. So how can you possibly trade against such massive demons or beasts, machines, right? Megabots? How can you possibly have any chance against them? You're not trading against them is the whole point. If you learn how to trade volatility, you're actually trading with them. You're on their side. Yes, your time frames, what you take action on, will be higher, but you'll see the general and the very specific movements and directions, and you'll be using the same math that they use. So yes, you won't run millions of trades per second if you're a retail trader at home on your PC running trades manually. And frankly, you won't be running millions of trades per second even if you use one of these $50 or $500 a month bots that you might rent from someplace. It's not worth it. Those bots are garbage for the most part, because even if they quote unquote work, right, they only really work if you manually administer them constantly. In other words, you're on them constantly. In other words, you're not actually getting any more trades done than you would by trading manually. And you can say I'm wrong, whatever. If you figured out a way to do it, to actually trade with the VEPs using a cheapo bot, please come and show us how. I'd love to see it. As far as I know, automating trading with a cheapo bot is a bad idea, because your bot will be competing against the other bots, and guess what happens to your bot when the bigger bots find it? Right? They're going to destroy it. They're going to destroy your positions. How do they know your positions? Because your positions are marked, right? Especially, where your entry is marked, wherever your exit, and they know if you're long or short, right? And if you think you're going to outsmart those bots, good luck. I mean, there's a reason these companies have invested hundreds of millions, if not billions of dollars, if you aggregate all the amount they put into it, with developing the software, buying all the hardware necessary, paying for all the maintenance of the hardware, paying for the engineers, the DevOps people, the managers, the traders, the overnight people, the overseas crews that do all this stuff, trading in different markets. So if you think you're going to outsmart those bots, you with your little $500 bot, good luck. And so that's why when you see like YouTube Jimmy telling you to, put your money in some bot farm where you can use a trading bot, all they're really doing is getting your money for the affiliate exchange deal or the affiliate deal that they have with that bot farm, right? And again, I'm not saying bots are evil or something. I'm just saying they're not going to ever be able to out trade the big bots, right? They may be able to run trades faster than you, but that doesn't mean they're going to win most of them. And in fact, regardless of whether you use bots or not, the average retail trader loses their money on a regular basis. And what I mean by that is, the average retail trader will get wrecked within 2 to 3 months. And what I mean by REKT is, I mean, you lose your trading capital. You won't be able to trade anymore with the money that you deposited initially. You're going to lose that initial deposit. And with leverage, it's even worse, right? It's way worse. Why? Well, because with leverage, you're going to lose that money a lot faster. It's designed to be that way so that you specifically go broke faster and give the exchange their money back faster. Because they're not in the business of giving you free money, in case you're wondering. Like, why is this exchange giving you 100x leverage? Think about it. You think they're just in it to give you 100 times your money? You think that's their successful business model and that's why they're so profitable? Because you're giving away 100 times the amount of money that you're putting in? No, right? They're giving you 100x leverage because they know you're going to misuse it. They know you're going to abuse it. And so they know you're going to lose it. Right? And that's so it's in their interest to give you leverage. Right? When you over leverage yourself in a volatile asset class like crypto, by the way, or in any other asset class, because these days, I mean, especially like stocks or even certain commodities like, I wouldn't say gold, but gold, I guess, relatively. But pretty much there's a lot of volatility across the board in pretty much every asset class. Now, some less than others. Yeah, sure, you could say wheat, soybean, all these kind of commodities generally have less volatility. Forex generally has less volatility than crypto. But still, if you look at like a 1 minute chart, there's volatility. Even if you look at any time frame, really, but there is volatility to trade on these relatively less volatile asset classes. Now, does that mean that you should be using leverage on Forex or commodities or stocks? Probably not stocks, because they're volatile enough. But Forex and commodities, it doesn't mean you should use leverage. It just means that if you know what you're doing with leverage, it can be a useful tool, especially in markets like commodities and Forex, where typically the percentage movements are so low that the average retail trader will use a little bit or a lot of leverage in order to get, more substantial gains or losses than they otherwise would. And since most traders lose their trades, what it really means is you shouldn't use it until you're actually familiar with how to use leverage properly. And that's not something that you can just, learn by just throwing it all in and going extreme. Because if you do that, you lose one trade, you're out. Right? You practice trading without any leverage at first, even if it limits your gains. And you do that over and over again until you're good at it consistently. And then, if you think that for some reason you're trading some kind of an asset where leverage may be of use, well, then you try, using quarter X leverage, half an X leverage, whatever it might be, 1X leverage. If you're experienced enough at it, maybe 2X, like in extremely experienced hands that know what you're doing, like 3 to 5X is probably the limit of what you should be using, at least certainly in volatile assets, right? In crypto. But if you're using it for like commodities and Forex, you're going to see places that are going to offer you literally multiple thousands of X leverage. Why? Because you might very well be trading assets that are basically, mostly flat the whole day. And so the only way to really get any gains is to do that. But still, why would they offer you such massive leverage? Think about it. Do you think that they think you're going to win most of your trades if you take such high yield, such high leverage as 1000x or more? No, it's because they know they're going to win your money. Because if it goes even one little pip in the wrong direction, you're out, right? What's 1000x leverage? Think about it. Like, if 100x leverage moves a 0.5% against you, 0.5%, not 1%, 0.5% against you, and you toss on trading fees, as most people tend to use things like market trades, okay, at a 0.5% they're already out because of the market fees, because that's an additional anywhere from a 0.5% to 2%. So if it moves a 0.5%, you're out, right? And you could be liable for much more given the fees. And so what's 1,000%? 10 times that, right? Instead of a 0.5%, it's right? Instead of 0.5%, it's 0.05%. How do you feel trading against odds where you can't be wrong by more than 0.05%, 1/20th, right, of a percent? You think you're going to outsmart the market with those kind of rates? Those kind of probabilities against you? Really? I can tell you, my guess is you're not. My guess is you're going to lose all of your money very, very quickly if you're using something like 1000x, right? But people do it. And they do it because they're cocky. They don't really want to learn how to trade. They just want to follow these YouTube jimmies who tell them to do something. You know, oh, look, this altcoin is going to go up, I think. You know, it's gambling, but yeah, we don't know anything about financial stuff. We just the biggest fools, and we like memes. Listen, I love a good meme. I'm not going to use it as my way to trade. You know, buy meme stocks because all the market cap is going to go there, and that's where the degens are. Okay, if you want to go trade with the degens, at least be on the right side of the trade, because they're not going to be. The degens tend to lose their money. That's why they're degens. Okay? And people that say otherwise are fooling you. So bear that in mind. Hey, Lucas, you're so big. Yeah, he's like a boy. Happy dog. So, yeah. Keep in mind that if you just follow the silly TA people, you're just lining yourself up to get wrecked. Now, what are the surprises I was talking about? Surprises I was talking about are, if you look at, you know, where Bitcoin has gone in the last 24 hours, it dropped a little bit right after all the idiots were saying it's gonna pump to the moon, right? Yeah, it immediately proceeded to drop, and then all of them started putting up panic videos. Oh, it's dropping, and that's normal, and it could go down to 50. That's normal. Then what did it do? It pumped right back up to where it dropped from. And then what did the idiots do? Put out more videos saying, yeah, we're going to the moon. That's it. This is the bounce I was talking about. You see that little dip was nothing. And then what did it do? It dropped again. So now, it's another classic example of why you should never follow these YouTube Jimmy idiots. They don't know what they're talking about. If they did, they'd be using the VEPs. And you can too. Come on into our server, alphatradinghq.com/discord. We have surprises for you as a trader, goodies you can enjoy. Cheers, happy trading.